Hello, Richard Calhoun, Creekside Realty, 40 years of working with clients here in Silicon Valley. We're here to talk about the real estate market for the past week. There are 21 slides that are posted. This date, June 26, is incorrect. It should be July 3rd. Moving into the first data slide, what we're looking here is comparing what's happened in the last week in the macro data, which is Santa Clara County, San Mateo County, single-family homes, condos, and townhouses, all put together in a blender. We're comparing it to the 5-year median. The 5 years I used were 2015 through 2019, which were all strong seller marketplaces. If we're having a normal marketplace, all three indexes would be right here on the yellow line. What are the three indexes? One is available inventory. And the trend on that now is becoming very clear, this blue line. At the beginning part of the year, we had more inventory than we normally did. People were still complaining about lack of inventory, but the inventory was 40% above normal. Then we got down to normal levels. Now we're down about 80%. And the last couple weeks, we've gone down now and we're only at 70% of the inventory we'd expect to have at this time of the year. What's even more significant is because we put everything in a blender, there's some market areas that are even experiencing a lower percentage. For example, Santa Clara County single family homes is the area where it's lacking the inventory the greatest, and other areas are a little bit higher percentages. I don't have the percentages broken down, but I will assure you that Santa Clara County single family homes is less than 70% of the inventory they'd expect to have. The next line is the gray line. You'll notice it bounces a lot more, but because we're looking at just the number of new listings coming on the market any given week. And with the holiday shifts, you can see the spikes happen. This is Memorial Day and this is July the 4th. And that's because one was Monday, one was Sunday. They're basically at the beginning of a week later than they normally are. Anyway, what you see on that is the inventory that's coming into the marketplace. The new offerings are basically right at 100% of normal with some fluctuation. So why is the supply so low? The supply is so low because look at the demand. The demand is the red line. We started off up here just a little fluctuation. Holidays weren't as important, so we were about 175% of where you'd expect it to be. We rapidly dropped to 140. We were probably about 130, 135% for a long period of time. And now because of the holiday timing, we skyrocketed back up and we're at 180% of the offers accepted. In the last week, we almost sold twice as many homes in that week as we would have compared to the past 5 years. To the right of the purple line is last year's data, so you can see that it was steadily improving after the pandemic and the initial shelter in place, which was way back in week 10, I think, of last year. But here you're only seeing week 27 of last year and on. So you can't, that's why I drew the vertical line. This is not a data point of predicting what the future is. It's just showing you where you were last year. So inventory was above normal last year. Now it's below normal. New listings were both right at 100%. Demand was only about 100 and what's that? About 110% of normal. Now it's at 180% of normal, and that's just separated by 1 week. So that gives you an idea of how much the market has changed. Now we're looking at days of unsold inventory. This is the single most important indicator, in my opinion, and that's because it's the supply-demand ratio. How quickly would we sell the inventory at the existing rate of sales? Normally, you can see the market starts slowing down, which is the gold line, and this year it's been basically flat, and this last week it went the other direction. It even got faster than it ever has been. And I believe we're now at a record fast DUI for Santa Clara County. Unfortunately, I'm not going to be able to show you the number, and it's from memory. I think based on the last week, it was 15.9 days, and the 5-week was at 16.7. For those that have been following me for a while, we got down around 17, and then we were creeping back up around 18. And I think last week we were about 18.7 or something of that order. Now we're down, I think the number is going to be 16.7. So, it's not a huge number difference, but you can only get so low. You can't get to zero. There is one micro market area, Foster City, very small micro market, and that's the only reason that happened. It's down at 5 days on sold inventory, so it's not even a week. Now what we're looking at is overbidding ratio. This is how much above asking price buyers are willing to pay, the sale price, list price distribution. The red dotted line up here is the best month we ever had, April of 2019. 2018. The blue is the worst month we ever had, December of 2001. The dotted lines are the oldest out of the 22 weeks that are on the graph. The dashed lines are the next oldest, and the solid lines are the most recent. The purple line, which is really getting hard, you can see it right about there, and you can see it here on the axis, and coming down here, you can see it. You can see it up here a little bit. It's pretty hard to see because all the recent weeks are basically right on top of one another. So basically that's saying that the market's picked up, it's plateaued at a very high level, and buyers are overbidding. They're not overbidding as high as we've done back in April of 2018, but they're a lot closer than that than they were in December of 2001. Here is looking at the amount of appreciation, since this impacts a lot of people, and this is the calculated percentage over here. This is the current week. And you can see there is a fair amount of fluctuation in some of the areas. Like if we go down here to Foster Cities, last week it was at 24%. This week it was at 15. San Mateo Coast was at 17.2, down to 4.4. It was all the way up at 31.6. So, basically this would suggest maybe some more expensive homes sold, which brought up the median for that. Because again, the San Mateo Coast, Half Moon Bay area, it's not a huge volume of area. So when you get a few fluctuations, and when I have the data points, it's for 5 weeks. So, you can see that it's trending off now. And if you look at it long term, you basically would say the San Mateo Coast really hasn't appreciated 2% for most of the period up here, got up to 20, 30, 25, 17. Now we're down to 4. But where you really start seeing the trends is in the larger areas like Santa Clara County single family homes. Very large database of transactions. And you can see the last 3 weeks, we've been basically flat at 24.1, 24.4% appreciation. And that's over last year. And that's the number here. That's the median sale price based on the entire 2020 calendar year. Just to give you some idea, the median escrow typically closes in the first week of August. And with that, I'm wrapped up. So I will take any questions before we go into details. Again, the date's wrong. These are the URLs. I call the green highlight my base URL. That will take you to the YouTube channel of past presentations. You add the 2021 Saturday morning and you join the live presentation. You add the word handout 2021-07-03 and you get today's handout. It is only 21 slides because I had a little data processing error this morning. And that's my contact information. So I'll pause to see if anyone's got any questions before I continue. Not seeing anyone unmuting themselves. Okay, so here's the first detailed slide. And this is showing the 3 largest micro market areas, which are single family homes in Santa Clara County, single family homes in San Mateo counties, and condos and townhouses in Santa Clara County. You can see that we've been pretty flat. We've been going up a little bit, but not as rapidly as you'd expect based on the 5-year median. But look at those last week. Look at the plummeting down in all 3 micro market areas. I think the explanation for that is sellers didn't come on, the inventory didn't come on the market because of the holiday, and buyers continue to buy the week going into the holiday. And so with less supply, if you have the same amount of buyers, boom, your days of unsold inventory decrease. It will be interesting to see if that can recover when you have only the normal number of inventory coming on the market. I don't think we're going to be able to recover. So I think it's going to stay at a fairly low level for the foreseeable future. Last week, I sort of hinted at, I think we're seeing a 2017 in the making. I think that's exactly what we're seeing. And for those that weren't familiar, that would expect a second wave of appreciation coming on the marketplace just about now that starts showing up in the August closings. So even though we've had great 25% appreciation this year, we may be in for another 10% before we get to Halloween. Only time will tell. Here is a geographical representation. This is single family homes. This is the days of unsold inventory. The redder the color, the faster the marketplace. At 10 days, it's saturated red. At 110, which we don't have, it's saturated blue. And between 42 and 75, there's no color. So we don't even have any between 42 and 77.5. Everything we have is between, I can't even say it's between 10, because here's Foster City, 5.8 days. So in less than a week, everything would be sold. There isn't even a week's supply of inventory in Foster Cities and Redwood Shores. Now, granted, that's a very small geographical area, very small number of homes for sale, but it's still it's a sort of a unique marketplace, which is why I carry it by itself. I don't really weigh anything on it, but you can see most of these numbers are in the 10, 12 range. And it's only when you get into Saratoga, Los Gatos, the expensive areas, you're at 22, San Mateo County at 40, does it bring up your average. But if you look at the affordable areas, look at these numbers. If we did just those, I don't know what the number would work out to be, but it's going to be probably 14. And that's insane. I mean, that's less than 2 weeks of inventory. Anyway, here is the number of active listings without an offer. And the reason I put in the without the offer is most people include some properties where the listing agent is asking for backup offers. And basically, again, you can see this is raw number versus percentage. We started off the year with more than the normal amount of inventory. We fairly rapidly, week number 9, got down to the equal levels. Starting about week 16, when inventory normally picks up, it didn't. It's just been flat. And so now we have this huge shortage, and the huge shortage of inventory supply, when you have an increase in demand, is what's causing the runaway prices and the runaway franticness out there in the marketplace. Here's the number of new listings. For the most part, those two lines are mirroring one another. So it's the fact that we have the extra demand that's eating up the same number of listings coming on the marketplace, which is lowering the level of the reservoir. How many listings are there to pick from? This is the number of new offers. And so this is the vertical separation here is the surplus demand. And, it's hard to really see, especially when you're climbing steeply. But if we come here, what are you talking about? You're talking about 175 additional homes every week. And when you're talking about 300, that's an extra 50%. Now, if you come up here to recent weeks here, you're around 500 and you're only having an extra 100, that's still an extra 20%. This current week, normally you'd expect somewhere around 350. We're at 650, not quite double, but that's like 45%, maybe something like that. That's huge. Even last year at this time, most people were feeling the market was recovering. The duration here was much smaller. The percentage and the magnitude, this is just starting to be pretty hard to believe. I don't know how long we can sustain this huge demand without having the inventory. Here's number of closings. Not a lot to say about that. Number of closings reflects what happened in the number of offers, just delayed by about 5 weeks. Here's the frequency of overbidding. You can see, and this again is the macro data, you're now above 80%. I think the number was 82%. So 82% of the sellers in all the different micro market areas in both types of property are getting more than their asking price. A year ago at this time, you can see only 50% of the sellers were getting it. And you can see it went up a little bit last summer and started off at 60%, which is pretty respectable. But it's hard to get 82% of the sellers getting more than their asking price in a large market and diverse marketplace. You can go into particular areas like Cupertino, Sunnyvale, and we've seen 95% of the sellers getting more than their asking price. But that's a homogeneous marketplace. If it's doing well, the entire area is doing well. When you start talking about macro data, it's not homogeneous. It's very blended. It's all kinds of different types of property and different types of price ranges. This is the frequency of the different areas. You can see the Santa Clara County single family homes is the highest up here at basically 85%. San Mateo County single family homes somewhere around 76% maybe, and condos and townhouses in Santa Clara County somewhere around 72%. So they're all doing well. They've, were increasing earlier this year. For the most part, I would say these are San Mateo County single family homes and Santa Clara County condos and townhouses are pretty flat. I'm sort of hard pressed to call Santa Clara County single family homes flats yet. You might be saying we're just now reaching the plateau. It was clearly increasing since the month of May and month of June. If we say July has leveled it off, I could go with that. It's hard to really call it that with that soon when you have that little data to go by. Same concept here. This is now the frequency of overbidding broken down geographically. Last time we were looking at the map, it was days of unsold inventory. And again, you can see the Foster City area right through here is a little deeper red than the surrounding Redwood City area. And so if you look at the numbers, Foster City is at 95.2% and the Redwood City area is at 77. So that's why you can start seeing the different color, the contrast. You can see the contrast between Mountain View and Palo Alto. You can see see it between South County and Santa Teresa. Some of the ones more closely here between Milpitas and Central San Jose, you really can't pick it up. And if you look at it, you're 84.7 versus 89. Yes, there's a difference of roughly five days of unsold or frequency of overbidding, but in the range, that just, you can't see the color. It's just not enough. I might be able to argue I can see the difference right here. This is going to be Evergreen down here, and this is going to be Central San Jose. I can sort of see the dividing line, and I guess I can see the dividing line here in Milpitas or Berryessa and Alum Rock, but it's pretty hard to really pick up. If you just look at it quickly, they look like the same color. They're doing roughly the same. Here's the magnitude graphically. You can see that they've come up. We're now getting about 108.5% of the asking price. It did drop down just a little bit this last week. Just some fluctuation. I wouldn't really worry about it. I think the number's 108.2% for this past week. Here's the macro broken down. Here, there's a little bit more contrast in the colors because the magnitude of overbidding is less. South County, even though it's doing relatively well, is a pretty pale pink, but that's still 105.7% of the sellers getting more or on average, sellers are getting 105.7% of their asking price. Nobody's getting below their asking price or even at their asking price. The lowest one I'm picking up right now is 102.5% in the expensive areas, Menlo Park, Atherton, right on the San Mateo, Santa Clara County border. We've looked at this slide a little bit. Again, it's just, we've already talked about it. There's really not much change. You can see all of them packed up. The reason I brought it up here is here you normally see more data. This is going back 12 weeks, but just in a glance, you can see the last 12 weeks have been basically exact mirror copies of one another. Here's the price distribution geographically. The blue colors just mean they're below the median price. It does not mean that they're in a buyer's marketplace. It's just the more affordable areas. The redder the color, the more expensive the area. So Palo Alto is the second reddest. The reddest is going to be Menlo Park, Atherton, followed by Palo Alto, Los Altos, followed by Saratoga, Los Gatos. Cupertino, Sunnyvale, along with San Mateo and Redwood City are basically in a three-way tie. So, you can quickly see, just real quickly, the median prices. The middle is the median, which most people follow. The number on the left is the lowest 10 percentile. The number on the right is the highest percentile. So using Cupertino and Sunnyvale as an example, it's hard to get a single family home below 1.8 million. The typical single family home sells for 2.4 million. The most expensive homes tend to sell for 3 million. Basically, in a $1.2 million range between 1.8 and 3 million is where 80% of the homes in Cupertino, Sunnyvale sell single family homes. This is a little bit interesting. It's sort of almost a preview of what we'll talk about next month. Now, just for full disclosure, you'll see this is July 3rd and it should be July 6th. So we're not comparing apples to apples, but we are comparing pretty close time of the year. So average days on the market is 46. We've been faster, 44, 40. So, that wouldn't speak by itself of a fast marketplace, but just like median sale price is more important, I believe median days on the market is more important because you get a couple people that have been on a market for a year, they lower their price, they finally sell, they really bring up the average, they don't really impact the median. So now if you look at the median at 15 days, that's the fastest. It's the fastest by a full week, at least based on what I'm seeing. The fastest previous time was here in 2018 at 22 days, or median days on the market. So that's a whole week faster. So that's significant. It's noteworthy that the median list price of what's currently available really hasn't gone up, but that's more of a market mix issue versus that there hasn't been appreciation. This is just a little bit of the square footage, so you know what the typical home is. Now you start seeing it more easily because now we're looking at what is selling. What's selling median days on the market is 8. We were 10 in 2017. So I talked about we might be starting to mirror 2017. We're actually faster. Average at 14. The best I'm seeing is 18. So again, we're faster. Days on unsold inventory, 16.4. So if we go back from today, 35 days, and we look at single family homes in Santa Clara County only, during that period of time, homes were selling in they weren't selling in 16.4. that's how long it would take to sell out the existing inventory. If you look back in 2017, it was 22. So we're actually faster again than 2017. The list price is 1.5 million. But when we get down here to the sold price, you'll see this median sold price is 1.7. So from what's going in escrow at asking to what's coming out at the back end at the sale price, there's a $200,000 increase in that median, which is pretty amazing. Sales per day, 35 or 38.5. Yes, we've had higher than that. The market in general has been slowing down, and I can no longer really say that. You can come back here to 12 when we were recovering from the 2007 recession and we were selling more homes. You can come back to the early 2020s and we were selling way more homes. I mean, all these are above 50 for 3 years in a row. So even though this is more inventory than we've experienced in a couple decades or in just about 2 decades, it isn't by no means a record volume. So yes, the demand is now higher than we've seen in the last 5 years using the 5-year median, but that 5-year median has been artificially low because the volume of sales has been going down, down, down. Again, you can look at what the typical square footage of the home is. And now you get down to closings, which gives you the sale price. It's nice to see the sale price because now you can calculate what the sale price to list price ratio is, and that looks like 109.9%. Now we've been higher than that, not at this time of the year, but at other times of the year, probably more like April and May. I think we hit 112.2% for single family homes in Santa Clara County. I think San Mateo County was 114, but I may be inflating those by 2 percentages. I would have to go back and look at that. But you can see, last year we were at, looks like 100.8%, then 101.9%. 107.8% in 2018, 105.8% in 17. So again, we've been in the same ballpark at this time of the year, but we've never been this high. So that shows that buyers are feeling the need to overpay. This is the frequency of overbidding at 85%. Again, we're blowing away all the previous numbers for this time of the year. Then you get down to price that a lot of people pay attention to. The median is now at $1.7 million. I mean, it was only a couple weeks ago we hit 1.6 million. The cheapest single family homes now well over $1 million at $1.60 million, and the most expensive homes are up at about 3.6 million. So basically, again, 80% of the homes in single family homes in Santa Clara County sell between $1.60 million and 3.6 million. The number of closings is 1352. That number goes back a long time. You actually have to come all the way back to, I think it's going to be 2004 to get a higher number. And that's the only year. It looks like there's 2 years here, 2005 and 2004, where we outperformed. And the reason for that, even though you had more sales coming out of the recession in 2007, buyers didn't sense the market was taking off, and so they were more willing to let a deal fall apart. If the seller wasn't willing to make repairs that were discovered, things of that nature. Now, if you find $5,000 worth of repairs, the buyer's probably going to accept it just to get out of the rat race. That's why, even though you've had more sales in the past, you really haven't had more closings until you get all the way back to 2004 and 2005. And I actually just noticed I somehow cut off this bedrooms and bathrooms. I'll bring that back so you can see what the typical house is. And that should be the last slide. So I'll put this back up. And again, this date is wrong. Today is July 3rd, 0703. These are the URLs you need, my contact information. I'll pause to see if anybody's got any questions. If there are no questions, I will wrap up and we'll see everybody next week. Does anyone have any questions for me?
Sure, this is Lily. Oh, so I think the impression that I got from your presentation is that the price and the market is still very active starting from now to Halloween, right?
What I'm saying is the market conditions right now look like they were very similar to market conditions in 2017. In fact, they look like they're more aggressive than they were in 2017. So
I see.
one of the things I do, I believe firmly that the marketplace is far smarter than me. And, it's basically called a quantitative analysis of the marketplace. You look at what all the buyers and the sellers are doing. And if they're performing similarly to like they were in 2017, much more so than any other year that I've noticed, then you sort of predict, barring something out of the ordinary, you'd expect them to follow their behavior of 2017. And that's only very noteworthy because normally we have one wave of appreciation that basically occurs, right at the beginning of the year. It takes a while for the consumers and prices to reflect that step increase. And then we basically plateau by Memorial Day. We sort of are at the peak and we're actually coming back down. But when that's happening, you're seeing DUI go up, you're seeing prices stabilize. We're still seeing prices going up. We're not seeing DUI go up. In fact, you're seeing the separation. So I'm not really predicting. I'm not trying to predict what the market's going to do. What I'm simply saying is the market conditions now look a lot like they looked in 2017. So if I was to try to predict, I would probably use the 2017 model.
Oh, okay. Yeah, well, I mean, yeah, it's happening now. So we can always tell every week is different.
Every single week is different. That's one of the,
Yes,
and frankly, when I started this, I thought I would be reporting, the slowdown caused by the pandemic. It blows my mind that we're having this kind of demand, and you look at other
yes,
industries like lumber, their prices are going up because there's shortages, but there's shortages because the industry was essentially shut down. There's
right.
a shortage of chips, and so you can't get all the electronics. So the electronics are in short supply. Real estate is now in short supply, but it didn't go away. We don't manufacture that many homes in any given week or any given year. For whatever reason, the buyers that have been sitting on the sideline for decades, in my opinion, because, I started doing this data in 1997. And basically, in global terms, the expected volume each year went down from the previous year. Now, there were a few exceptions to that, but we used to sell 2,000 homes a month. We don't sell 2,000 homes a month now. And the
Yeah,
population is greater, there's more houses to sell. You would be expecting that number to go up, not down. So what it's clearly saying is people are staying in their homes longer and longer and longer. But since the pandemic, we reversed that. And no, we're not back to the levels we were in 2000, in 1999. And 97 was probably one of the best years in my career. We're not back to that level, but at least this year we're getting close to that level. But the industry has been sized for the performance for the last 2 decades. So if for the last 2 decades you were selling 1,000 homes a month, and now you're back up to say 1,400 homes a month, that's a 40% increase that your industry isn't set up to handle. And you're seeing shortages, you're seeing less maybe escrow services, you're seeing longer delays potentially in getting termite inspections, things of that nature as each industry ramps back up. Well,
yeah,
everybody enjoy the 4th of July. If you're listening to this before or if after, I hope it was a good one for you all. Take care.
yeah. Okay, thank you, Richard.
You're welcome. Take care.
You too. Have a good 4th.
All right.